Okay, so welcome back. Today in this slide, we're going to go over support and resistance and how it plays into technical analysis and how you can trade it. So let's get right into it. Okay, so what is support and resistance? Support and resistance are key concepts in technical analysis, helping traders spot entry and exit points. In an upward or bull market, resistance marks a level where seller activity increases, restricting price from rising further. When price climbs again, the previous low becomes support, representing a level where buyer interest helps stabilize price. The opposite occurs in a downtrend. What is support in trading? Support is a price level where selling slows due to buying interest, acting as a floor that prevents further decline. When price nears support, buyers often increase demand, causing price rebounds, which is a potential buy signal. Resistance is the opposite. It's a level where rising prices stall from selling pressure, acting as a ceiling. As price hits resistance, sellers emerge, pushing price down, which may be a signal to sell or short. Traders use two main strategies based off of support and resistance. The bounce, buy at support, sell at resistance, and the break, buy if price rises above resistance and sell if it falls below support. Support and resistance aren't exact numbers. Prices may test these areas, often shown by candlestick chart shadows or wicks. Here's an example. Notice how the candle shadows tested the 14,700 support level. Although it looked like price was breaking support, it was simply testing the level. There's no clear rule for determining if support or resistance is broken. Some say a close beyond the level is enough, but that's not always true. Let's revisit the example to see what happened when price closed below 14,700. Okay, so as you can see in this example, the price dipped below the 14,700 support level but quickly recovered above it. Selling on this false breakout would have led to a loss. The support held firm and even strengthened afterwards. There are three key factors to know to avoid false breakouts. To avoid false breakouts, treat support and resistance as zones rather than fixed numbers. Use line charts instead of candlestick charts since they highlight closing prices and reduce noise from market reflexes. Plot support and resistance lines where prices form multiple peaks or valleys, focusing on intentional movements. Okay, so what happens when support or resistance is broken? A break in support usually triggers further declines, while breaking resistance often sparks rallies. These moves reflect shifts in market sentiment. Breaking support signals sellers control, price typically drops, and traders may go short. Breaking resistance indicates buyers' dominance, price usually rises, and traders may go long. Support and resistance represent collective market psychology. Support attracts buyers who see value, while resistance brings in sellers who expect prices to fall. Notably, broken resistance can become new support. Frequent tests reinforce the strength of these levels, and the follow-through after a break depends on how strong that level was. Okay, so with trend lines are a common yet often underused tool in Forex trading. When properly drawn, they are as effective as other methods, but many traders incorrectly force the lines to fit market movements. What are trend lines? A trend line is a straight line on a chart that connects two or more price points to show the direction of a currency pair's movement. Traders use trend lines to determine if the market is moving up, down, or sideways. An uptrend line connects support areas or valleys and is called an ascending trend line. In a downtrend, the trend line marks resistance areas or peaks as a descending trend line. When the market consolidates, a horizontal trend line can show support or resistance within a range, though technically these lines indicate levels rather than trends. Types of trends. There are three types of trends: uptrend, higher lows; downtrend, lower highs; sideways trend, ranging. So how do you draw trend lines? To draw Forex trend lines properly, all you have to do is locate two major tops or bottoms and connect them. And it's that simple. Look at these examples below. Yes, drawing trend lines is simple, but it also requires skill. How to draw trend lines. Identify the trend. Check if the market is moving up, down, or sideways. Connect points. For an uptrend, link 2 or more lows. For a downtrend, connect 2 or more highs. Touch as many points as possible without cutting through prices. Extend the line. Project the line forward to spot possible support or resistance. And adjust as needed. Update the line when new data appears, fine-tuning for accuracy as the market shifts. Here are some important points to remember using trend lines in trading. It takes at least 2 tops or bottoms to draw a valid trend line, but it takes 3 to confirm a trend line. The steeper the trend line you draw, the less reliable it's going to be and the more likely it will break. Like horizontal support and resistance levels, trend lines become stronger the more times they are tested. And most importantly, do not ever draw trend lines by forcing them to fit the market. If they do not fit right, then that trend line isn't a valid one.